rating agency's point of view. My name is Ricky Gartz. I'm the City of Plainfield's Chief Financial Officer. I'll be your moderator today. Today you'll be hearing a presentation from Tiffany Tribbett and Doug Goldmacher. But first, a few comments. I get to the second page. Happy hour by the Bay reception begins at 5:30 on the deck. All phones should be on mute or turned off at this point, please. Tiffany Tribbett is an associate director at Standard & Poor's Global Ratings with the local government group in the U.S. Public Finance Department. Tiffany covers local credits in the Northeast region, including municipalities, counties, and school districts in Connecticut, Massachusetts, New Jersey, New York, Maryland, and Virginia. She's the lead portfolio analyst for municipalities and counties in New Jersey. Prior to Standard & Poor's Global, Tiffany was a state budget specialist at the New Jersey Office of Management and Budget. While with the state, she was the primary analyst for the K-12 education budget, working on both school funding and Department of Education budgets. She also covered a portion of Department of Environmental Protection's budget. Douglas is currently an analyst in Moody's Public Finance Group and the lead analyst for local government credits in New Jersey. He joined Moody's as a member of the surveillance team in 2013 and has experience in a diverse portfolio of local government credits in New Jersey, Pennsylvania, New York, Ohio, and Alabama. He's the lead analyst for numerous credits, including Atlantic City, Jersey City, Bergen County, and the Passaic Valley Sewerage Commission. He's also the author of Decoding New Jersey Municipal Accounting, which explains the adjustments Moody's makes to New Jersey fund balances. Prior to joining Moody's, Douglas worked for Xerox. He received his BA from Duke University with a double major in history and French. He holds an MBA from the University of Rochester Simon School of Business. Welcome.
All right.
And Matt Jessup, too.
And me. And Matt's back. So Ricky and I were chatting in between the break. He said, in that last session, you guys spent all this time talking about what the municipal issuers should do to sort of, make the best presentation for other rating agencies. And the rating agencies were sitting in the room. You sort of gave away the secret to the sauce a little bit with them there. But payback's so here we are, and as Sherry said on the last panel, we have an opportunity. It's finally your opportunity to ask questions, right, of the rating agency. So we're going to spend a little bit of time hearing first from Tiffany. She's going to give us S&P's views on a couple hot topics or trending items here in New Jersey. Doug is going to do the same. They have not seen each other's presentations, and for the most part, they're actually different. So you're going to get several different perspectives on a host of open issues. And then we will start asking some questions. Again, we have some questions, but hopefully you have more. You don't have to identify yourself, so no one can read your tags from up here anyway. So ask the questions anonymously. It's fine. Tell everyone you're from Parsippany. These guys won't care. Ask as many questions as you want, and we'll get these guys to answer them. And get you out of here a little early to happy hour. So with that, Tiffany, why don't you give us a sense of what S&P is focused on these days?
All right, I'll keep in mind that I'm standing between everybody and happy hour. So I wanted to Sherry actually covered some of this for me, so getting us even faster to happy hour. But I did kind of want to talk about what some of the credit conditions that we're seeing in the New Jersey portfolio. And so as the lead portfolio analyst, a lot of you in this room have probably spoken with me. I know Sherry talked about our surveillance process. A lot of the times I'll reach out, call, talk to you all, get some answers. And it's not a formal ratings agency review, but just so, I'm friendly, come say hi. I'll be at that happy hour. But so quick refresher on our criteria. Sherry covered it, but just it's here. And I did want to note that these slides will be posted online. I do have an appendix, which has a lot of our detailed criteria. I know Sherry talked a little bit about it with all of our scores and the ratios that we look at. So all that's available for you all after this. But just to add to what she already spoke about, that gets us to our indicative rating. And from there are some ways that your rating can change, including some notch adjustments for positive things, for negative things, and then also our ratings caps. And I'm not going to go into them in detail, but I will touch on one in a couple of slides. So what are we seeing in New Jersey? I'm going to start with the good. So we have seen a lot of economic growth. I keep joking, I think everybody's getting a grocery store. So many new grocery stores of late. A lot of housing construction picking up. A lot of our shore communities have finally recovered the ratables that they lost after Hurricane Sandy. We're about 5 years from that now, so we have seen that coming back. And then we also have seen falling unemployment across the state. Atlantic County and Cape May County both recently fell below 10% unemployment, which is important to us because we do have a criteria point about that ratio, and it does improve the economic scores of credits in those counties. So we did see some upward rating movement in the last year as a result of some of those changes that we've been seeing. So in general, I would say New Jersey is just very strong economically, especially when we look across the country compared to national peers. We really do have very strong economic numbers here in New Jersey. Now on the negative side, so we have seen rising fixed costs, and I think it's important to think about it in a criteria context because we do have a rating cap that can be triggered as a result of these fixed costs. And so we look at that as your debt carrying costs, your pension and OPEB costs. And so OPEB, any post-retirement medical benefits that you have out there, dental, et cetera. And so if that combined ratio starts to approach 50%, you're gonna start having an uncomfortable conversation with us about what's going on there and what's happening and why is this happening. Because it can cause what we call a straight to four condition under our financial management assessment, which I'm gonna talk a little bit more about that at the end. But that will cause you to have a capped rating at no higher than an A rating level. And it doesn't matter how great everything else is, that's gonna be the highest your rating can be. So I think that's really important to think about as we move to the topic of pensions. I know it was alluded to, and I think that might be the only overlap Doug and I have here, but so that you know, I know that, and everybody tells me again and again, why are you asking me about pensions? This is a state problem, this isn't a local problem. So we use the GASB ratios, and that reflects the risks of the common pool. So all of the assets, while we recognize that they are separated when you're calculating your ADCs and whatnot, there is actually no legal separation of the assets in the plan, and thus when you see those GASB ratios on the 67 ratios, it's reflecting the fact that the state hasn't paid their ADC for over 10 years, but it's also reflecting that as we approach the crossover dates in those plans, when they run out of money, there could be risks from the viewpoint that we see, and you'll see a lot of that now. If you've recently come to us, you've probably seen a lot of language from us about this topic. And it is something we are keeping a close eye on. I know that the state, there was some recent, we put them back to stable with the lottery changes. No expectation of deterioration in the fund balance, or the funding ratios in the next year, but we don't know what's gonna happen coming out. Which brings us to the next topic, which is just there's a lot of uncertainty right now. And with the state, we do have a governorship election this year. I think everybody's probably watching that closely. It should be quite the contest. But we don't know what's going to happen. We don't know what's going to happen with pensions. We don't know what's going to happen with school funding. I think most of you all in here are counties and munis, but we do also rate the school districts. And we did see for the first time in several years aid cuts to those districts. And we note that the state does disclose they are underfunding SFRA, and it's about $1 billion. And so we just don't know what that's going to mean for the state budget and how that could trickle down to our local credits. And it's bigger than just pensions, but there's a lot of uncertainty at the state level. And then at the federal level, we also are tracking a few things that could really affect us here in New Jersey. Starting with, I'm sure everyone in this room is paying attention to the muni tax exemption, and if that is or is not going to be part of any tax reform that moves forward. But we're also looking at, are they going to include the loss of the state and local income tax deductions? It's a big thing for our New Jersey residents here. And then another thing that you see a lot of NJ.com articles on it, but we're also paying attention to what's going to happen to the state's budget if they change Medicaid funding. And how might that affect what the state is able to do with pensions and school funding, et cetera, and charity care and all of those things. And so those are some of the big topics that we're kind of looking at bigger than just when we talk to you all, but that could definitely have an impact on you. And so that brings me to why we care about our financial management assessment. And so with a lot of the uncertainty that we have out there and a lot of those negative pressures we see, we want to know that you're looking forward, you're looking ahead, you have plans to address the uncertainties and the potential pressures that are coming. And so I want to make it very clear what is our assessment and what the assessment is not, because I think it's kind of a point of clarity for people. It is not a personal assessment of you. It's nothing that you've done or your performance or anything about you personally. It is just about policies and practices. And I think Sherry talked about it, informal or formal. We do want to know about all of those things. And so to go through this specifically, and I know Sherry and Kathy talked about it briefly, but we don't see a lot of these here in New Jersey. So I say standard, we call them standard, good, and strong. So standard management scores are standard. The vast majority of our credits, we do see at the AAA and AA plus end, we will start to see a lot more of the good and strong scores, but it's still a lot lower than we see compared to national peers. And again, we are looking nationally. Our committees are composed of national folks, and so it's something that we do need to go through when I'm on a committee and I'm talking about the fact that you've utilized about 50% of your surplus, but it's going to be regenerated and this performance trend is strong, and I swear that the fund balance is not going to be drawn down by half next year. But it's something we have to go through every time, and not having a policy to turn to and say, well, how low could they draw it down to? Well, I don't know. So that's why we look at these things. And then just to quickly kind of talk about what do we look at. We look at your revenue and expenditure assumptions, which is basically how you build your budget. Budget amendments and updates, which the state, obviously you can do your transfers after, I think, November, and then make an amendment if needed. Rare. But it's mostly about when are you reporting to your governing body? Are you giving them monthly budget to actual reports, quarterly? How often is this happening? And if they see that something is off trend, are you able to take action to correct it and make sure that you end balanced? Long-term financial planning is the rarity here in New Jersey, a formal long-term plan, but we are looking. Do you project out 3, 4, 5 years? Are you looking at your expenditures and your revenues and factoring in how the property tax cap may apply your ability to address some of those challenges and needs? Capital plans, much more common. I know we do the 3, the 5, the 6, but we do look for a 5-year rolling plan. And we do like to see all funding sources identified by year for all projects, because I know there's a wide range of detail on the state mandated capital plans there. The investment management policies, almost everybody has a cash management plan, but we do look at when are you reporting on your holdings. I know that you largely in bank deposits at this point, but still, are you reporting on holdings and interest to your governing board? And then the last two, while the state does have kind of restrictive debt management policies, we do like to see that you've formally adopted some things around your carrying charges and why you would issue debt and where your goals going with debt. And then finally, reserve and liquidity policies, and Sherry and Kathy talked about those, but we do kind of look at, do you have a reserve policy and is it tied to your cash flow needs? And so that's our FMA. I know that there are some additional questions about it, so I'm happy to talk about that and more. But for now, that's it.
All right. So while you guys need to switch your... So Doug is with Moody's. Doug is going to give us sort of his take on some of these hot topics. Again, I suspect pensions is one you're going to hear again.
Yes, you will.
Right. But after that, that might be about it. So we may see some different thoughts here out of Doug and Moody's.
All right, so hi, everybody. And as my colleagues here have said before, I will try not to take up too much time. I know everyone wants to get outside already. So with that in mind, I'll jump right in. You know, the old saying, may you live in exciting times. I think that we are in exciting times in New Jersey. And I think to sort of mix my literature metaphors here, that we have a tale of two states. We have some issuers who are exceptionally strong. They're doing very well. We've seen a raft of upgrades. Things are going really well at the local level. And we still have a core of mostly urban, weaker issuers who are still having some systemic problems. They're fighting very hard to try and address these. But there's definitely an issue there, and you'd be surprised to really think of them as being in the same state sometimes. Pensions, the unfunded pension liability continues to rise. Now, even separating out the local from the state portion, and even though the locals are paying more than the state is paying, that unfunded liability continues to go up anyway. We do have a couple of other issues coming down the pike, which I think will be of some considerable importance to everybody. A big one is the arbitration cap. It's due to sunset soon. What's going to happen with that? There are several possibilities that could happen, so I'm not going to try and predict what will happen, but I will say whatever comes down is going to have a credit impact. School funding is a topic which we've been talking about forever, probably, and what's the plan going to be for that? Is it going to be status quo, a change, and if so, what kind of change? And then there's the state itself. We'll get to that in a minute, but I'm sure you can imagine some of the things we'll discuss. So basically, we'll just quickly mention most New Jersey issuers have pretty healthy finances, improving tax bases, very high wealth. The places which were hit by Sandy are recovering strongly. Debt tends not to be too high in New Jersey. Small number of the issuers have the weaker finances, stagnant or even declining tax bases, high poverty, elevated debt, elevated fixed costs. I'm not going to pick anyone out by name, but these are overarching trends, and you can definitely see this split between the really strong and the not so strong. Brief slide about pensions and the unfunded liability. So the chart on the left is about the contributions which you make. The green, I guess we'll call it, is the contribution currently being made for PERS. There's a similar chart available for PFRS, and I could have put it up there, but I didn't want to belabor the point. I think you'll get the idea pretty well for this. The contributions, even though they're growing by a pretty significant amount, fall well short of tread water. Tread water is a term we're defining as the minimum amount you need to contribute to prevent your liability from growing. It's not even enough to bring that liability down, it's to prevent it from growing. And this is with the plan assumptions, which we frankly think are extremely aggressive. So even with the plan's own assumptions, which again we don't believe in, you're not really contributing enough to hold level. And you can see this on the other side, on the balance sheet side, where the liability keeps climbing. Now you can measure it on the net pension liability side. Those are the reported GASB numbers. That's again the green, going up steadily. And then we have our ANPL, which is the Moody's adjustments to what we consider a more comparable set of assumptions for use around the country, and that's also growing. So no matter how we chop this, it's growing, and the contribution is not currently enough. Now, this is kind of a peculiar situation in some way for everyone in this room because you don't control how much you put in, and we absolutely respect that. It's not something we can say, oh, I'm just going to contribute a little bit more this year. You can't. You pay what you're told to pay. And so this isn't a reflection of your managerial skills, but it is a reflection of the reality. And the big question is going to be, what's going to happen with that? Now, right now, the local portion, assuming, as Tiffany quite correctly pointed out, that we keep, legally they're the same fund, but assume for the sake of argument that they will be kept totally separate. Still, something has to be done about this. Now, we think at this juncture that most of the locals have the capacity to deal with that, that if they were told to pay more, you'd all scream and rant and rave, quite justifiably. No one wants to pay more, but most of you could. But eventually, something's got to give. So I'm not sure exactly how many years down the road there'll be a crossover point where it'll start being too difficult for you to make that contribution because each year you don't pay it, the gap widens. But it's something to watch. So it's something we're keeping our eye on. Back to the arbitration cap. What does the future hold? Right now, this is a pretty big positive. You have your cap on your taxes. You have your cap on your largest expenditure. So they kind of go in sync. What's going to happen with that after it sunsets? Will it be renewed, modified, repealed, changed? I don't know what. Until we know, I'm not going to try and prognosticate what the impact is going to be, but there's going to be an impact. And I will say there are other states which have tax caps but no arbitration cap. So it's not unprecedented for it to happen. There are also states with wildly different structures for all of this. So if you want to make your private guesses, there are states where you could see what the results have been there, but that's a sort of offline topic. School funding, I really mentioned the highlights there. I don't know what's going to happen, but whatever happens is going to have an impact. In addition to the very obvious social and educational component, it's a major source of money for repaying debt. So whatever happens, there's going to be an impact. And then there's the state itself. So New Jersey, A3 stable, is now the second lowest rated state after Illinois, which is Baa3 negative. Now, I will say there's some very strong strengths here. I should, full credit, by the way, this strengths and challenges cribbed shamelessly from my colleague Bay Larson's last State of New Jersey report, so I didn't write this. But
Knew I'd seen this before somewhere.
you have absolutely seen this before. The only thing, so the first bullet and the last bullet are me, and the beautiful headline. Strengths, high resident wealth levels. This is one of the wealthiest states in the country. I think every year it's like top 3, moves up and down with Connecticut and that sort of thing. So well-educated, diverse economy, strong executive powers to reduce expenditures, variable rate debt, not really an issue from a credit perspective here. Challenges: low reserves, low liquidity, structural imbalance. We already mentioned the pensions. I don't need to say any more about that. We don't really have multi-year budget projections. We don't have binding consensus revenue forecasting. And that's all at the state level. And again, it's not something you can really handle so much, but we've seen other states that get into tricky situations push problems down to the local level. So again, I don't know what exactly they would do, and certainly the New Jersey Constitution has some protections against that in the form of the unfunded mandate language, but there are ways and means, and the simplest one would be to just reduce state aid. So again, I don't know what's going to happen. I'm not saying they will. It's something we're watching, and we want to see, will they do something? And you know, every time the state has a conversation with Bay, I'm in her office the next morning to say, so, how does that impact me and my guys? So, yeah. But I don't want to be too doom and gloom here. Overall, the picture's positive. So I don't have the numbers for September, even though it's, you know, we run them at the end of the year, but January to August, we've had 27 upgrades, only 3 downgrades. And if you take a look at the ratings we have on the right, which hopefully are, yeah, they're pretty legible. This is a strong state. These are a lot of very high ratings. And if you notice, there's a very fat tail on that side, and only a handful of the more pressured credits. And a lot of those more pressured credits are doing better. So, you know, hopefully things will continue to do well. But we do see a number of things coming down which we need to pay careful attention to. And those were my major points. There's the legalese I have to put in, but you know, compliance mandates.
So Doug, on that last slide, I mean, this may be a little unfair, but it does strike me that these numbers are pretty impressive for New Jersey municipalities, right? I mean, you have 45 AAA or AA1. You have another 71 on top of that that are AA2. Do you have a sense of how that where that puts us relative to some comparable states? You mentioned Connecticut earlier, obviously another extremely, you know, a high wealth state. Are the ratios sort of similar across other states?
Not off the top of my head.
Okay.
I will say I can comment a little bit about the different legal structures of certain states, but it's really got to be the ones which I do, which may not all be the most connected. But one thing I will mention is we also have an institutional framework score, which is built into our management score. New Jersey ranks in the AA, which is the strong category. One state over in New York, things are a little bit different. They also have a cap, but they don't have the exemptions that you have for pensions, OPEB, and debt service, which are really kind of major exceptions. So that's a weakness there. They also have the Triborough Amendment. So if you don't if you don't agree to a new contract, your old contract keeps going. And if you had a very favorable contract years ago, there's no incentive to ever get a new one. I can't remember how many years Buffalo's gone without a contract, but it's been a long time. So proportionally, I'm going to guess, though I don't know, maybe New Jersey has a few more higher ratings than New York, but that's a guess.
I would add to that, we've been recently putting out what we call our credit condition reports, and you can actually take a look at what are the state trends. And we do see, for example, in the Northeast region I work in, I know Massachusetts and Connecticut, we do see the higher rated credits, but then also some of the distressed credits. But I always say it's the New Jersey thing where we have just incredibly strong economics, but maybe lower fund balances or the standard management scores. Whereas if you go to the South or the Midwest, you might not see the economics that we have here in the Northeast, but you do see a lot more of those strong management scores and the very, very high fund balances that I recently rated someone with 80% fund balances, which I don't think anyone in the room could imagine.
So I want to get into a couple of questions, including some that somehow I've managed to remember since the last session. But I then also want, again, anybody here, feel free to raise your hand, stand on the chair, do whatever you want to get our attention. We'd like to take these guys would love to take your questions as well. So let me start with one of the things we talked about at the last session, which was purchasers rating notes after their purchase. So, from the issuer's perspective, my concern is always, the issuer maybe hasn't been looked at in a year or two. Things are, I'm sure they're better, but maybe they're not as good for whatever reason. There was an event, a drawdown on reserves. We have an explanation. You may not talk to us about it. So the concern is that through that process, obviously, there's going to be an adverse view of our rating by virtue of just trying to sell a $5 million note to get some roads done, right? And that's not sort of a process we want to go through. As Sherry mentioned earlier, we didn't get the note rated in the first place for a reason. So I guess the question is, do you do you go through a full review like that? Or is it as simple as we've reviewed you in the last year, you're an investment grade rated municipality, so we'll give the note a MIG 1? Right, because you typically don't talk to the issuer when you get it done, do you?
We do.
Yes.
You do, okay, all right.
So, I don't know if you want to go
You
first.
can- you
Okay.
can go first.
I'll just say, if the investor calls and says, I would like to get this rated, my response is, sure, let me arrange a phone call with the issuer. And then we go through it with the issuer. As per usual, the investor does not get to say anything else until it's publicly released. Once they have put it in, I don't know, maybe there's some commercial stuff that they do. I don't care about that. That's someone else's problem. But from my point of view, once it's started, it's business as usual, except that the sale date happened in the past. And I will badger you unmercifully if you won't talk to me, because I do not want to rate anything unless I've had that full conversation, so I understand what's going on. I don't ever want to be in a position where I say, I don't really know exactly what's going on. Committee would, I'd be in a lot of trouble.
Right.
Yeah, no, we go through the full process. It does not matter who has requested the rating, whether it came from you, from the issuer, from the investor, whoever, I'm doing a full rating.
Yeah, I'll tell you my favorite thing I've heard from somebody who had a post-sale note rating, and they go, oh, well, we weren't expecting to talk to you guys for like 3 or 4 months. So we do the full thing, because it's important to note, even though we are rating it under different criteria, we start with your rating. We start with your underlying rating, and then the note rating is off of that rating. And so we do a full committee, full review, and even if you've just recently, 2 weeks ago, talked to us. So it's really important. I know Sherry talked a lot about having the documents and things. I always stress, if you know that you're simultaneously issuing notes with a GO issue, make sure we know everything about those notes, because it'll make that process faster when we can talk to you again in 2 weeks once somebody bought your notes and wants a rating on them. So.
Okay. So Tiffany, we talked a little bit in the last session too about surveillance ratings, right? It seems to me sometimes it's every year-ish, it's every 2 years, sometimes it's 6 months later. I mean, is there a formal policy? Is there a goal that sometimes you get to, sometimes you don't? How does that work?
We look at everything every year. So every single one of you, if you have an S&P rating, at some point this year, will have reviewed your 16 audit and seen something. Maybe I'll call you, ask for, oh, I saw that you didn't regenerate everything. What happened there? And then there are cases where we will do the full review, and I think Sherry did a nice job of kind of laying out where she's seeing those.
So we also review every single one of our credits at least once a year. And the reason we would call as opposed to not calling is because of one of a couple of reasons. One, there's something in there we just want to get some clarification on. It's not necessarily up or down. We just want to make sure we understand. We could see a positive trend, in which case maybe there's a conversation for an upgrade. We could see a negative trend, in which case maybe we have that conversation. Or it could just be it's been a really long time and we feel like, wow, it's been so long, maybe we should probably just touch in, make sure we understand everything, that we're still fresh on it. Because from our perspective, investors are relying on our ratings to be good, not just when you sell the bonds, but also 5 years, 10 years, 15 years, however many years down the road when those bonds are outstanding. We just want to make sure we still understand everything.
Which I would add to that, Doug made a good point about investors. We get investor calls about your ratings all the time. I mean, I just took one this week for something I rated 6 or 7 months ago, and we are constantly looking at these credits, and we do need to know, what's going on in our profiles. So.
We talked a little bit in the last session about choosing the rating agency, right? And about right, I know, and about having a rating with S&P, then maybe going to Moody's or vice versa for the next sale. Under what circumstances do you guys consider dropping ratings that on existing debt that's already out there?
We have a couple of reasons why we would do that. The most likely reason is that the debt we rate has matured, in which case it's done.
Yeah, that one doesn't
So
count.
that-
That
okay,
one-
so
yeah,
leaving that one aside.
On debt
Okay.
that's still outstanding.
Okay, on debt which is still outstanding.
Right.
The
Take the easy way
primary
out.
reason then would be because we don't have enough information. So at certain points of the year, we have a process where we go through and we say, okay, do we have updated financials for your community? And if we have, then done. We check it off and we don't bother you about that. If we don't, we start sending you letters. Could you send us your audit, please? We start calling. Could you send us your draft audit? Could you send us your AFS? Can you give us anything which will let us say we'll keep going? Eventually, you reach a point where we don't have enough to say with confidence, yes, the rating is still X. And I know that because I've looked at these numbers. But if I don't have numbers, eventually we'll put you on review and say if we don't get numbers within a certain time, we will withdraw the rating. And then eventually, if we don't come up with something we can use, we'll withdraw the rating. That's the far and away the biggest reason. We're really not in the business of withdrawing ratings if we can help it.
Yeah, I would add two things. That first of all, if you have a 2016 audit and an S&P rating, please do send it my way. I would appreciate that. But
I'll echo that.
because we do. I mean, I'm sure we sound really annoying when we've sent you letters and called so many times, but I honestly check once a week at how many audits I have outstanding in New Jersey to see how many folks I still need to talk to, how many financials haven't I seen, and I'm looking at AFSs. I'm trying to get that information because we do have an end of year deadline where we're looking for those things. So if you don't send it, I'll be in touch. But the other thing that I would add, Sherry talked about I think, Matt, you may have asked that, is there a difference between a new sale and a review process? And there's not, and we will withdraw ratings if we can't talk to you when we need to do a review. If we need to do a review and we have questions and we need to set up a call or send out those questions for you to answer them, and you don't get back to us in a timely fashion, we will put the rating on credit watch. And if we still can't get in touch with you, we will withdraw the rating.
So, yeah.
Alan Negrian, rather than a town, I'll just say I'm past president of the GFOA. We saw in the S&P presentation that the institutional framework had a 10% value, and I took that to be a credit to New Jersey's system of accounting. And Doug, you mentioned that the institutional framework was part of your management analysis. I did have the opportunity to read your Decoding New Jersey Municipal Accounting.
It's a great read, isn't it?
And I'd like you
That book.
I'd like you to comment on the ACBOA system that we use here in New Jersey for those that haven't read the article, and tell us whether you consider it to be a positive or a negative in your analysis for our ratings.
The overall accounting structure?
Yes, please.
Yeah, so the thing I'll say first is it's a unique structure across the country which requires some special understanding. But overall, I'd say it's a very conservative accounting structure in the overwhelming
Agreed.
majority of cases. There are one or two where it can look a little bit different, but overwhelmingly it's very positive. So what we have done is to say, if you just look at the reported surplus number you give, it looks terrible compared to the rest of the country because it doesn't include your receivables. It doesn't include your appropriation reserves. It doesn't include a whole host of other reserves. But you have that money, so we add it back in. And that's why the number which we report as your fund balance number doesn't appear anywhere in your audit. And I say in almost every case, it's considerably higher than the one you report. Now, there are a couple caveats to that. There are a few things you can do which we subtract out, deferred charges, for example, unless they're offset by a note which is paying for that, because that money really has been spent already. But overwhelmingly, the fund balance increases every single time. And it is a very conservative form of accounting, and I think that's a plus.
Thank you.
Could I just clarify one thing? On the 10%, that's of the overall indicative score. It's not necessarily that New Jersey's institutional framework score gets a 10%. It's a strong score. It's a 2, so it's about in the middle there.
So, Tiffany, you mentioned in your portion of the presentation that your review committee is made up of people, I guess, who look at credits all over the country right now, which was, so one of the main focuses of this session initially was to get a little better sense of how that credit review process works on your end, right? We make our presentation, we give the best presentation possible, you're armed with all the information. We don't really have a sense of, okay, you go into this big, dark, windowless room with a panel of people, right, sitting way high above you, and you're at a table with a trap door down to shark-infested waters, like, and trying to, we want to know that you're advocating on our behalf, right, that you're, carrying the message, and I think it's important, right, to everybody here that they know that there's someone in that room, since they can't be in the room, sort of fighting for them. So I have a host of questions, or maybe you can just say as much as you can say about that process. One of them was, what is the makeup of that committee? Do they all understand New Jersey credit, New Jersey accounting as you need to, as sort of Doug mentioned and wrote about brilliantly? And how does that process sort of work?
Yeah. I'll tiptoe carefully here, but I will let you know, we have recently published a commentary. It's on our public-facing website, so it's not behind our paywall or anything. And it's about the S&P rating process, and that document really kind of goes through what is the process, what happens after the call, what is the committee makeup, how does that look, how does that work, what goes on there. And so we are a national organization, so your committee might be composed of members in the Northeast, or it might be half of California and folks from Alabama, or who knows, well, maybe not Alabama, we don't have an office there, but Texas. There's a variety, and so I'll have to say, like, you know, I can do my parlor trick later where I explain New Jersey accounting in 30 seconds. Because there is a range of familiarity with it. So again, I know I mentioned it in my presentation about surplus and having a fund balance policy and then walking everyone through the reserves appropriations, but you know, it's not really true because there's all these lapses that are there and they're gonna regenerate and we're gonna be here and we really just need to talk about what's the amount that's gonna be regenerated and talk about the final fund balance where we're gonna be. And I think Phoenix, when they do their slide presentations, will have that net number coming forward so that we can see what the end result is. And it is, you know, in that process, it is on us. We have to be able to explain these things. So if you've explained it to us, we can explain it. But if you haven't explained it to us, we can't explain it. So that's all I would say. But I do encourage everyone to read that. It has a little more compliance-approved language about the process.
But I mean, is there and again, you guys can answer as much of this as you can, but is there I mean, does it start with you making a presentation almost similar to the presentation that we make? Or is information just distributed and a Q&A just sort of ensues?
So the way it works is I'm going to put together a package of material for all my committee members, which I'm going to send them in advance so that they have a chance to look it over, think about it, etc. Then when it comes to committee, I have a presentation, but it's not I'm not standing in front of a panel in a and we use alligators, not sharks. But
Sharks are endangered, I get it. No.
But joking aside, it's, you know, if they have questions, they can interrupt in the middle. And the way we look at it, our goal is not to treat this as an adversarial process within the committee. The goal is to get the right rating. So if that means discussion goes back and forth, then discussion goes back and forth. We have a senior credit officer who serves as chair. We'll make sure that we get to all the material we have to get to, and also make sure everyone's encouraged to give their opinions and so on and so forth. So we have a good conversation. And like Tiffany, we have people from all over the country who come into these meetings. I usually schedule some time in advance with them to explain the beauties of New Jersey accounting and make sure they understand, unless it's someone who's already been on this, in which case maybe just a little refresher is necessary. We could also bring in people from other teams, though, if necessary. So if, I don't know, a hospital is a major player in the credit somehow, I might bring in somebody from the healthcare team. I might bring in somebody from the gambling team. I might bring in somebody from the higher ed or who knows, anything. If I need them, I'm going to bring in that necessary skill set. I'll also say that as we go through, if we feel the need to add more expertise, we can stop the committee in the middle and bring in more people until we get this to the point where we're comfortable with a majority rating. Majority vote settles this. No pluralities, we go until we have an actual majority.
Yeah, I would say it's similar, but I would also add to that. I mean, Sherry talked a bit about our criteria, and we really do walk through our criteria, and that's how we're going to get to a rating, and then our discussion is always going to be around that criteria. And so if you do take a look, like, we are talking about those ratios. We are talking about what goes into those ratios and what might not be in those ratios. And again, with the performance, which is one of our financial metrics, that's where we get into that conversation about how much fund balance has been appropriated, how much is going to be regenerated, what's the actual fund balance that we're looking at here.
In your report and presentation, you obviously have already sort of redone the math, taken into account all, converted it from New Jersey to national before you've
I've got a beautiful
all of
spreadsheet for that.
Right. Have you also found the need to pause the committee for more information from the issuer?
It could happen.
It can happen.
Okay.
I'd prefer to get everything in advance for both the sake of, a smooth, fast process, so that we don't have to reconvene a committee, because then you have to reschedule things again, which is always fun. And also, your time's precious too. I'd rather not. So that's why I sometimes ask questions, which may be like, oh, no one's ever going to ask that. Yes, they're going to ask that.
Right, well, that's just it, right? I mean,
They
you're
are
asking
gonna
us
ask it.
questions, but you never
Yeah.
know what questions you're gonna get asked by your committee.
Right,
of-
so after the first couple, you realize ask everything you can to the issuer now, so I don't have to bother you 5 times afterwards. If I have to, I will, but I'd really rather get everything up front, so, you know.
And to that end, it's helpful, things like notes. I mean, New Jersey issues notes probably more than most of our other states that we look at. So if you've told us what your plans are to issue, what your plans for takeout are and pay down, like that's really important information
Definitely.
for us to have.
Right, and that's one of the things that we didn't really focus on too much in the last session, but one that I know you bring up often is, you know, there's 2 issues, right? One is the timing between selling notes and closing notes to pay off old notes. I suppose in the event that I mean, back in 07, 08, there were a couple times where we couldn't actually get those sales done. That was sort of the, you know, the only time, I think, as far as I know. But so looking at that time frame, whether it should be a week, 2 weeks, 3 weeks between pricing and closing, or closing and maturity of the existing note. And then the other one is sort of a liquidity analysis, right, of, you know, when your note is coming due, how much cash do you have on hand to be able to pay off that note if you had to in a pinch, and then go and refinance it, you know, somewhere 3 weeks, a month, 2 months later when markets eased, or you do a bond sale instead of a note sale, et cetera. How important are those sort of planning tools in your analysis?
Yeah, I mean, that's built into our criteria. We do look at how much short-term notes you have that could come due that would have to be paid out when we're looking at your liquidity, and if you could cover that, and if it's a larger percentage, what that would mean, and it can affect your score. So it's detailed in that. I will point you all to the appendix, because I always say don't trust a number out of my mouth unless it's in front of me. So I do encourage you. It is on the liquidity slide.
Yeah, I'll add, we publish our methodologies at Moody's.com. You can go there and find the band methodology, which explains all the numbers. I have a similar issue with remembering the exact percentages and such. But I will say the largest component of a band rating is your long-term rating. But your liquidity, your timing, your backup plans to the extent which you need them. New Jersey tends not to rely as heavily on backup plans as some other states because there's a strong band market here. But that's all taken into account. But it's also taken into account if you have a strong history of being an issuer. So if you're a regular issuer and everyone says, oh, yeah, no, we know them. This is normal. This is not out of nowhere. That's a strength. That shows demonstrated market access, which, frankly, most places in New Jersey have. On the other hand, in some other states where bans are far more unusual, you know, you don't get any uplift for being a particularly regular issuer except under the most, you know, more extraordinary occasions. It'd be like, oh, that one has it, but not the whole state. Most of New Jersey has pretty strong market access.
And our criteria is also, if you want the full criteria, not just the Cliff Notes version.
One of the things that we've been sort of debating, I think, for years with you all now is written formal policies, whether it's debt issuance policies, whether it's fund balance policies. You know, you've been on panels like this before. You've talked about how those policies are important, not just to have in practice, right? Well, for the last 5 years, we've done this, which maybe gets us a couple points, but not all the points available. We have it written down, but the governing body hasn't adopted it. I mean, there's varying stages of it. And in part, I think a lot of our issuers don't have that because on the other side of the table, we've had the financial advisors who have said, we don't necessarily think that's always a great idea. It may put you in a box. It may put you in a position where an unanticipated event happens and you're going to look at them and say, well, you had a policy, but you violated it. You ignored it. We're going to penalize you. And there's sort of a no-win situation. So is there a balance in the credit criteria where the issuers can get credit for policies without putting them, and I presume you understand that we don't want to put them in this box where, you know, they can't get themselves out in an unanticipated event?
You know, I recently had an issuer. So one of the things we look at with reserve policies is actually, do you have a replenishment policy in place? And if it's a permitted use of reserves, is there something in place that's going to get you back to where you were? And I've recently had a credit where it happened, and we were like, yeah, okay, well, that was a permitted use. They've got a plan, and it's coming back. Like, we're good with that, and that's still the policy there. So there are ways around that our criteria kind of takes that into account with the being compliant with your policies. It's all about how your policy is constructed. But I do encourage to take a look at the FMA criteria. We do have an entirely separate criteria piece, and I always tell issuers, You know, the state of New Jersey is subjected to the same FMA criteria, the city of New York and the smallest town in New Jersey. It's the same criteria for everyone. So it's something to keep in mind that maybe, you know, financial planning is not really something you're looking at, but, you know, those policies and practices really do carry a lot of weight in our committee conversations around some of the pressures that we see and some of the nuances with New Jersey accounting.
Doug, tax appeals.
Yeah.
One of the things we talked about in the last session were good, you know, positive credit events and credit events that are maybe negative. Tax appeals have been an issue in our state in the past. Feels like they're getting better. What is the view if I've got a tax appeal, you know, a number of appeals pending, the view on financing them versus trying to pay as I go, figuring out a longer-term plan to get my appeal number down over time? Sort of what's the view of, you know, from your perspective?
So I'll say that a tax appeal in and of itself is not something I'm concerned about as a tax appeal. I'm concerned about the impact on your finances. So the question for me when looking at your tax appeals is, first, how big are they relative to your budget? How big are they relative to your tax base? Is this essentially a trivial matter which barely moves the needle? Then all right, tell me that's it and we'll move on. Is it a larger issue, but you have a history of budgeting for it carefully? So whether it's in the form of building it into your budget or you sort of regularly bond out, as long as you have a sensible plan for how you're dealing with it, again, we're fine. It starts causing difficulty when either you're not budgeting for it or not handling in a way which you have a plan which makes sense, or where it gets to the point where even if you have a sensible plan, it's just such a big component of your budget that I don't care how brilliant it is, it's a huge deadweight loss. So those are the 2 points where it starts to get troublesome, where one, you don't have a plan, or two, it's just really big. Now, the plan could come in lots of different ways that would be acceptable. You could budget for annually and say, I'm just making up numbers here, that it's typically it comes in at $90,000 a year, we budget 110, the occasional year where it's a little bit off, we have a small reserve, whatever. You're fine. It's clearly in your budget and you're good for it. Maybe tax appeals are a little bit more irregular for you, so it's not like we budget for it annually, but we've built up this nice healthy reserve, so if something goes wrong, we're covered. Okay, it's a very sensible plan. It could be you're bonding out. Now, if you have to do this constantly, now we're starting to add up, you know, more and more debt, which you have to pay for long term. It's a sign of a little bit of pressure. But again, the important thing is, do you have a plan? Does the plan make sense? Is the plan affordable? And then are you going to stick to the plan? Because I'm going to come back next year and say, so what happened?
Right.
We're really big on plans.
Oh, yeah. I think that's for both of us. We like plans.
Right. Well, Doug, you and I were joking earlier. You know, a lot of times with these issues, you know, it's not the crime, it's the cover-up, right? It's not the event. It's the planning and describing and following through after the fact.
Absolutely.
That seems to me you guys care about almost as much, if not more, than you do the initial event itself, right? Okay, there was a draw on the reserve. That may not be a big deal. What is the plan at why and what is the plan
Absolutely.
after, which is just as much, if not more, than what happened in the first place. So with that, unless anybody else here has a question, my last one for Tiffany is, will you do your accounting parlor trick at the bar in half an hour?
In half an hour.
That's
you will,
exactly what we want while drinking,
then
right?
that'd be great. So with that, Ricky, I think we're all done. Thank you, everyone.
Just one house cleaning item, if you can remember to log in at gfoanj.org and complete the survey, they'd appreciate it. Thank you.